Richard Cookson, Global Chief Investment Officer at Citi Private Banking, joins us now. Hi, Richard.
Morning.
So you're not there with lacquer?
I don't know quite what he's smoking, actually. I heard it exactly the same at the beginning of last year, Mark. Exactly the same bullishness about the US and sustainability and all that. A lot of what's happened in the US, and by the way, you've had the weakest recovery since the Second World War, despite the strongest monetary and fiscal policy the US has ever seen, right? But a lot of what has happened is partly because of a seasonal adjustment problem, because of very weak Q4 and Q4 08 and Q1 09. That's still going to be a problem this year, not as much of a problem as last year.
Yeah.
So the numbers aren't actually as strong as they look at the moment. They weren't as weak as we thought they were last summer, but they're certainly not as strong as we think now. You've got a very warm winter, which has brought forward an awful lot of activity.
Yeah.
You've got gasoline prices that have now hit $4 on average a gallon, up from $3.30. And you've got nominal wage growth that is still extraordinarily meagre, so there's no way of offsetting that. So assuming that people do carry on getting into their cars and driving around come the summer, I mean, they've not done very much of it in the winter, and you've got heating costs have been lower because of natural gas, but gasoline price going up, I think that starts to slow. And that's regardless of what happens elsewhere in the world, right? We've got the Eurozone already in a recession. The only question really is how bad it gets. And we've got a slowing China. So it seems to me that Mr. Lacker is extraordinarily complacent. I didn't quite understand why everyone was so exercised about the Fed minutes. All they said was, if it carries on getting better, we won't have to do any more.
So you're saying they probably will have to do more now because the economy is going to worsen?
I would think it's probably quite likely, not yet. But it's as a statement, it's a statement of the bleeding obvious, isn't it? If things get better, then we won't have to do more. Sure, that's absolutely true. But I very much doubt whether they're going to get as good as people think, which is, of course, why bond yields are stuck on the floor still.
Consequently, US equities, you say, are expensive?
No. You're making a leap there. No, you're making a leap from the fact that growth is not great to the fact that equities are expensive. Equities are expensive in the US no matter what happens to growth.
Right.
Right. So your cyclically adjusted multiple, we use the Schiller multiple, it's 22 in the US. It's 12 in Europe. In fact, after yesterday, after the last couple of days, it's probably more like 11. Yeah. Right. So the great consensus out there is, and you talk to any client around the world, is that you sell Europe, probably some, the margin, maybe emerging markets, and you buy the US. But the fact is that US multiples are extraordinarily high. You are already paying hugely for that. And in order to be bullish about US equities, you have to assume that the highest corporate profit margins, pretty much ever, will go higher still. That's what you have to assume. Well, that may happen because records are there to be broken. Yeah, exactly. But if you were a betting man, would you say that they're more likely to fall than to rise? I know where we stand.
And the other view which stands out, Richard, is your view on China. The view out there seems to be, yes, it'll weaken, maybe not by too much, but you're going a little bit further, aren't you?
Well, the overwhelming consensus is this fabled soft landing of the Chinese economy. Look, China has had a property bubble and a credit bubble. Until the autumn of last year, from January 09, Chinese house prices nationally had doubled. They tripled since January 05. If you look at credit as a percentage of GDP, credit had grown by about 65 percentage points of GDP over 4 years. That is massive. And if there is one sign of impending trouble, regardless of what economy you look at, it is the rapid growth in credit. Now, if China slows dramatically, commodity prices fall, that's what happens. If commodity prices fall, emerging stocks and emerging currencies come under pressure, and commodity currencies as well, which is why you've seen a weak Aussie dollar recently. That's just what happens.
What do we buy then, Richard?
So you buy, on the equity side, you buy the stuff that looks a bit more like bonds. You buy companies with high-end rising and sustainable dividends and strong balance sheets. You buy the stuff that's been, as it were, kicked to death already. So, we're not that uncomfortable with Europe, at least in a relative sense, because you're much better off buying valuations in Europe than the US because you're paid for a lot of that downside risk. We have liked Japan for the last year and a half. Now, we had a bit of a bumpy road beginning of last year, but since then, Japan has been an astonishingly good performer, not just the big caps, but the small caps. Why? Because in the long term, there is one thing, and one thing only, that gives you good returns, and that is valuation. And for the first time since I was in short trousers, which despite my boyish good looks is rather a long time ago, Japan's actually cheap.
Yeah.
Right? Japan now only trades, despite this rather big rally we've had this year, still only trades at book value. And the book is actually worth something in the case of Japan. It's probably worth much less in Europe because of the problems about the banking systems. But that's all past, right? So Japan's gone from over 5 times book in 1990. It's basically been devalued and devalued and devalued.
Yeah.
It went down to less than book value. So you buy the stuff where you're paid to take the risk, not where you're not paid to take the risk. If you look at the US and you look at quite a lot of emerging markets, you're not paid to take that risk.
Richard, great chat. Thank you very much indeed.
Nice to see you,
Richard Cookson there, Global Chief Investment Officer at Citi Private Banking.